So we'll continue with the concepts of taxation. The accrual equivalent after tax return can be thought of as the effective annual return after incorporating the effect of taxes. So if the account balance in 5 years after the payment of all taxes is $165,617, assuming an initial investment of $70,000, calculate the accrual equivalent after tax return. Let's assume that the equivalent after tax return is R, that is after all taxes and everything have been paid. So $70,000 have become at the end of 5 years an amount equal to 165,617. Had they been invested at the rate of R, then at the end of 5 years they would have become so much. Or we can compute R, or the accrual equivalent after tax return, as 165,617 upon 70,000 to the power 1 by 5 minus 1. That comes out to be approximately 18.8%. If you've calculated the accrual equivalent after tax return, we can use it to calculate the accrual equivalent tax rate as well. So assuming that our pre-tax return was 21% and our effective return has come out to be a value of 18.8%, our effective tax rate or accrual equivalent tax rate can be calculated as 21 into 1 minus the tax rate has become 18.8%, or the accrual equivalent tax rate is nothing but 18.8 upon 21 subtracted from 1, which comes out to be 10.48%. So what this essentially means is that taxes may be levied in any manner. They could be on capital gains, on realized capital gains, on income, on interest. On the whole, the taxation is equivalent to an accrual tax of 10.48%, such that our return of 21% over the term has become an equivalent amount of 18.8%. Now, many accounts will provide tax benefits. Tax benefits can be front-ended, as in the case of tax deferred accounts, wherein contributions reduce taxable income and are taxed only at withdrawal. In a tax deferred account, for example your PF account, if you make contributions, then those contributions will be treated as an expense, or they will not be taxed at all. They will only be taxed at maturity or when you withdraw the funds. So tax deferred accounts provide you tax benefits in that they defer the taxes to a later period and you gain on the time value of money. In back-ended tax benefits, contributions are made from after-tax money. So whatever you contribute to these accounts will not give you any tax benefit in that year. However, when you withdraw the funds many years later, whatever returns that you have earned will not be taxed, or money is withdrawn tax-free. Front-ended means it reduces a taxable income, but subsequent returns will be taxed. Back-ended means initially it doesn't reduce your taxable income, but future returns are not taxed. Depending on the rates and the circumstances, one may be better over the other. Assume that $50,000 is invested in each of the 4 accounts below. Calculate the after-tax value in each account in 10 years if each account earns 10% annually and all investment income and returns are taxed at 30%. So first is an account taxed annually, that is with accrual taxes. So if we invest $50,000, so we'll do the calculations more generally so that you can substitute any values and then compute the answer. So to compute the future value investment factor after a particular time, we can start with whatever is the present value. If it earns a rate of return of R, on that R we will be required to pay a tax of R into 1 minus T, and the same will keep getting compounded for the next n years to give us the future value investment factor. PV here is 50,000, R is 10%, and the tax rate is given to be 30%, and N is 10 years. If we put the money in a tax deferred account, then today it will help us reduce our taxable income. So we will deposit an amount PV that will give us tax benefit in reducing our taxes, and the tax will have to be paid later at the end of n years, after which we withdraw the money. So the returns will accrue at the rate of PV into 1 plus R to the power n, and we will be taxed at the rate of whatever is the applicable rate to compute the final value. Please note, in this case we will not add an amount equal to PV, or we will not add PV into T as we did, because this is a tax deferred account. So whatever money has gone into this account, there already hasn't been any tax paid on that money. When we withdraw this money, we will have to pay a tax not only on the returns but also on this initial amount that we had invested. So PV into 1 plus R to the power n will entirely be considered our profit, or will entirely be considered as income on which we haven't yet paid any tax. So the value after this would be into 1 minus tax. If it was an account with deferred capital gains and a basis of $45,000, in option 2 our basis was equal to 0. That is, we haven't paid any tax on it yet. If the basis was $45,000, that is, to the extent of $45,000 we have already paid the tax. So we now only will pay tax on incremental profit. So again the value would become 50,000 into 1 plus 0.1 to the power 10 into 1 minus 0.3. However, we'll add back the tax that we have already paid. This way we are taxing the entire amount. We are taxing the original 50,000 also. So we'll add back 45,000, that is our basis, into 30%. This is the tax that we have already paid, so we don't have to pay again. If we put the money in a tax exempt amount, then the $50,000 will grow uninhibited at the rate of R for the next n years. There's no taxation whatsoever. Please verify the calculations. An investor pays current and future taxes at 30%. The investor can contribute $10,000 in after-tax dollars to a tax-exempt account, or $12,000 to a tax-deferred account. Assuming an investment return of 12% for 15 years, calculate the future values of the following 3 account structures. First is an account taxed annually. So in a savings account, money will go from after-tax dollars. So we will put $10,000, and then the money will grow at the rate of 12%, and on the return that we earn every year, we will have to pay tax at the rate of 30%. So this will be a return after 1 year, and these proportions will continue for the next 15 years. So this will be the value of an account taxed annually, like a savings account. Money will go from after tax dollars, and returns every year will be taxed. If we invest in a tax deferred account, for example a retirement account, then we can invest a larger sum. We can invest $12,000 because we don't have to pay tax initially. This amount is not taxable. This will grow at the rate of 12% for the next 15 years, and when we withdraw the money, we'll have to pay tax on not just these returns but also this $12,000 that we never paid a tax on. So our net value would be into 0.7. If we invest the money in tax exempt bonds, then again money goes from after tax dollars. However, henceforth it is tax exempt, or the money will grow at the rate of 12% for the next 15 years. So please compute the value in all three accounts. Please verify the amounts. Assume the investor in the previous example pays current taxes at 30% and expects a future tax rate of 15%. Determine which account will have the greater future value. So again, he can put 10,000 in the savings account, or 12,000 in the tax deferred account, or 10,000 in the tax exempt account. Let's ignore the savings account, wherein some taxes will be at 15%, some taxes will be at 30%. Compute the difference between the tax exempt account and the tax deferred account. In this case, the tax exempt account will now give us the same amount, because anyways we weren't paying any tax, or it will give us a value of 54,736. Whereas the tax deferred account will now accrue at the rate of 12% for the next 15 years and will then be taxed at the rate of 15%, giving us a value of 55,830. So if we expect future tax rates to go down, then probably the tax deferred account may be better as compared to a tax exempt account. Please remember, taxation reduces the volatility or reduces our risk, because tax is calculated as a percentage of the income. So when our income goes up, tax in absolute dollar amounts also goes up. And when the income goes down, tax, because it's levied as a percentage in dollar amounts, will also go down. So if our volatility of pre-tax standard deviation is 10%, then you can verify that the volatility of post-tax standard deviation would be into 1 minus the tax rate. If the tax rate is 30%, then the volatility of post-tax standard deviation would be 7%. So let's assume our pre-tax income is $100 and the tax rate is 50%, so that the post-tax income comes down to $50. If the pre-tax income goes up by 10%, that is becomes $110, the post-tax income will become $55. If the pre-tax income goes down by 10%, that has become $90, then the post-tax income will become $45. We can calculate the standard deviation of the pre-tax income. That is, first calculate the deviation. The mean will be $100. So the deviation will be 90 minus 100, that is minus 10 square, plus 100 minus 100, that is 0 square, plus 110 minus 100, that is 10 square divided by 3. And similarly, we can calculate the standard deviation of the post-tax income. The mean will be 50. The deviation will be minus 5 square plus 0 plus 5 square divided by 3, and we can take a square root. So we can see that the standard deviation of the post-tax income is equal to the standard deviation of the pre-tax income multiplied by 0.5, or the pre-tax income has a standard deviation 2 times more than the post-tax income, or the post-tax standard deviation is equal to the pre-tax standard deviation into 1 minus the tax rate. Suppose an investor has 60% of his portfolio in stocks and 40% in bonds. The returns on the stock investment are taxed at an annual rate of 30%, and the bond returns are taxed at a rate of 35%. The pre-tax standard deviation of stock returns is 15% and the pre-tax standard deviation of bond returns is 8%. Calculate the pre-tax and after-tax standard deviations of portfolio returns, assuming the correlations between stock and bonds is 1. If the correlation is equal to 1, then summation or standard deviation of the portfolio will be sigma 1 square plus sigma 2 square plus 2 correlation into sigma 1 sigma 2. If correlation is equal to 1, this will simply become, there will be a W1 square, W2 square, W1, W2 also. This will simply become W1 sigma 1 plus W2 sigma 2 the whole square, and if you take the square root, it will just be the weighted average. So W1 is 0.6 multiplied by 15 plus 0.4 multiplied by 8, that will come out to be 12.2% on a pre-tax basis. If the tax rate is 35%, on a post-tax basis, it can similarly be calculated as W1 sigma 1 post-tax plus W2 sigma 2 post-tax. The post-tax standard deviation would be the pre-tax multiplied by 1 minus the tax rate. So it will be 0.6 into 15 into 1 minus 0.3, that is 0.7 in the case of stocks, plus 0.4 into 8 into 1 minus 0.35, that is 0.65 in the case of bonds, and the summation will give you the post-tax standard deviation of the portfolio, that is 8.38%. Now, generally speaking, it is advisable to keep bonds in tax exempt accounts because of the high current income that they give in the form of coupons, and to keep equity in taxable accounts because of lower current income and possibilities of tax loss harvesting, etc., that we'll study. The value created by effective tax management is referred to as tax alpha. Generally speaking, traders, because of their frequent trading, forego the tax advantages associated with equity. That is, all gains are taxed at the short-term rate and are taxed on an annual basis for traders. Active investors trade less frequently, such that many of them are able to defer their gains for the longer term and are able to enjoy lower rates. Passive investors buy and hold equity so that gains are deferred long term and are taxed possibly at even preferential rates. And tax exempt investors hold all their stock in tax exempt accounts and hence they avoid taxation altogether. So generally speaking, if there is the highest rate given, the traders would normally be taxed at that highest rate because all their gains would be short term. They have never held a security for a very long period, hence there is no question of a long term capital gains tax. Active traders, you will assume, have an intermediate term horizon and they will be taxed at that intermediate term rate. They would be realizing their gains over an intermediate term horizon. Passive investors would hold investments for a very long period, possibly years at stretch, and will enjoy the best long-term rate there is. Considering the case of 4 equity traders who invest $5,000 for 20 years and earn 10% annually, they pay tax of 35% on gains realized in less than a year and a tax of 30% on gains held a year or longer. What are the future accumulations? What are the future accumulations for each trader? First, we'll take the example of the trader who will invest $5,000 and will generate a return of 10% annually, but 35% of this return will directly be taxed and paid. So his final value will become 5,000 into 1 plus 0.1 into 1 minus 0.35 to the power 20. Second, we'll take the example of an active investor who is also realizing the gains. So in about a year's time, approximately, he also realizes his gain. But since he manages to hold the investment for about a year, he is taxed at a lower rate. He is not taxed at 35%, he is taxed at 30%. But he also, we will assume, realizes the gain by about a year's time and hence is taxed at the end of every year, and the investment will grow for the next 20 years. The passive investor doesn't recognize his gains at the end of every year. So he lets the gains accrue, and at the end of 20 years will pay the long-term capital gains tax at the rate of 30%. Finally, tax exempt investors don't have to pay any tax at all, so their savings will grow at the rate of 10% for the next 20 years. Please note, in the third case, we won't have to pay tax on the $5,000. So we need to add 5,000 into 30%. That is his principal amount that will not be taxed. So this will be added to his overall value. So please verify your answers. Tax loss harvesting is defined as the practice of using investment losses to offset gains and thus reducing the tax outgo. So an investor has realized a capital gain of $150,000 and pays a capital gains tax rate of 30%. The investor is considering selling Scrip X to reduce his tax bill. Scrip X has a cost basis of $180,000 and has fallen to a current market value of $100,000. Calculate the investor's tax payment if Scrip X is not sold and if it is sold. So if Scrip X is not sold, then his gain is $150,000 and he'll pay a tax of 30%, that is $45,000. If Scrip X is sold, then his total gain will reduce to the extent of $80,000. That is the loss that he has realized on the second scrip, and hence he will pay a tax on $70,000 to the tune of 30%, that is $21,000. Continuing with the previous example of the $150,000 capital gains, we'll assume that the investor has the opportunity to use the proceeds from the sale of Scrip X, which had a cost basis of $180,000, to buy an equal number of shares of Scrip Y at the same price. And that is the price of $100,000. He can sell it at $100,000 and buy Scrip Y at the same price of $100,000. Scrip Y offers the same expected return as Scrip X and is considered nearly identical to Scrip X. Over the next year, both stocks increase from $100,000 to $200,000 and the position is liquidated. Calculate the tax alpha and the investor's tax payment in 1 year under the two options. First, Scrip X is held and sold at the end of year 2. And second, Scrip X is sold at the end of year 1. Scrip Y is immediately purchased and sold at the end of year 2. If Scrip X is held and sold only at the end of year 2, that is, no purchase of Scrip Y and no realization of the loss, we have at an $80,000 loss on Scrip X that we are not realizing because we are not selling it. Hence, the entire $150,000 will be taxed at 30% at the end of year 1, and there will be a loss of $45,000, or there will be a tax payment, not loss, of $45,000. If we sell Scrip X at the end of year 2, whatever would be a tax liability in that year would further get appended to the extent of $20,000 because $180,000 was our cost basis and the current price is $200,000. So another $20,000 into 30%, that is $6,000 will have to be paid as tax at the end of year 2. So our total tax payment becomes $51,000. If scrip X is sold at the end of year 1, then at the end of year 1, our capital gains would get reduced to the extent of $80,000, and we will have to pay $70,000 into 30%, that is $21,000 at the end of year 1. Scrip Y is immediately purchased and sold at the end of year 2. Scrip Y has a cost basis of $100,000, so we get this $100,000 and we purchase scrip Y because we don't want to change the portfolio, we just want to do a tax arbitrage. So the return on the portfolio remains the same. This scrip Y is also a similar company in the similar sector, and it also goes up by 100%, so this also becomes $200,000. Our capital gains now would be $100,000 because the cost basis was only $100,000, and we'll pay 30% of this, or tax of $30,000. So in both cases our total tax liability remains the same, that is $51,000. However, there is an amount equal to $24,000 that we have been able to defer from year 1 to year 2. Whatever is the rate of interest that we can earn on this $24,000 difference is called the tax alpha. The highest in first out tax loss accounting simply says that when you're selling something, try to sell the highest in first. That is, the highest purchase price should be the first to be sold, so that it minimizes your tax outgo, or it minimizes your profit. The lowest in first out methodology may be followed if tax rates are expected to rise. Then you may want to book the capital gains earlier and pay a lower tax rate on them. So generally we follow the highest in first out methodology. If tax is expected to rise, then it may be beneficial to book profits earlier and follow a lowest in first out strategy. Generally speaking, more volatile prices have a higher potential of creating a tax alpha, that is timing these gains and losses so that you can defer taxes or you can generate some additional return, as we saw in the previous example. If all stocks are gaining, then there is limited scope of harvesting. Similarly, if all stocks are losing, then again there is not much tax alpha you can do. If there are some gains and some losses, then you can adopt strategies like these. Even though excessive trading creates tax inefficiencies, limiting trading to the extent of capitalizing on tax loss harvesting opportunities, as we just saw, can be beneficial. So when we sold scrip X and bought scrip Y, trading to that extent can be beneficial. On holding period management, we found that high trading generally leads to higher taxes and low trading leads to lower taxes. That is, the long-term capital gains will be applicable, which is generally lower than the short-term capital gains. Investor A is an extremely active trader whose returns are always taxed at the ordinary tax rate of 35%. Investor B follows a minimum trading strategy, only recognizing long-term capital gains of 20% each year. Both recognize gains and pay taxes annually. Investor A's strategy produces returns of 12%, whereas the strategy followed by Investor B produces returns of 10%. Determine the before tax returns that would make the two strategies produce equivalent after tax returns. So at the moment, Investor A strategy produces 12 into 1 minus 0.35, and Investor B strategy produces 10 into 1 minus 0.2. So investor A, because of his higher tax rate, is making a lower return to the tune of 7.8%. Now, if the returns have to be the same, either investor A needs to make more return or investor B needs to make less return. So we'll get two answers to the question. That is, either A makes a return of X such that X into 1 minus 0.3Y is equal to 8%, or investor Y or investor B makes a return of Y such that Y into 0.8 is equal to 7.8. Both will be returns at which the two of them will make equal after tax returns. So please verify X comes out to be 12.3 and Y comes out to be 9.75. Finally, theory says that the mean variance optimization that we studied earlier was with the assumption of perfect capital markets. That is, there are no taxes, no trading costs, risk-free borrowing and lending. If taxes are included, as they should be included, because most investors will be taxable investors, then the mean variance analysis will have to be redone. So efficient frontier ideally should be calculated on an after-tax basis. Both risk will get reduced and return will also get reduced. So when we do our optimization, even the risk should be multiplied by 1 minus point or 1 minus the tax rate, and so should the return. Optimization process also needs to include or consider the inclusion of tax advantaged accounts if the investor has any. So that's about the review on taxes. We'll start off with estate planning next. Not very important, mathematical, easy. Make sure you understand the concepts, do a couple of questions so that you can solve any question on this chapter. Thanks a lot and see you next time.